So, welcome everybody after the break, and thank you for staying with us to discuss value for money. We have heard throughout the morning today comments about retail investors choosing the markets overseas and investing a lot in the US. So as I said before the break, we would like to say as retail investors, help us, help you, provide better returns here, and we will be very happy, of course, to invest in the EU. And I would now invite Karel Lannoo, who is our moderator today, and the panelists on the stage for the discussion on value for money.
Thank you, Alexandra. So good afternoon. We will have continue our debate from this morning. I think we discussed already a bit issues related to the retail investment strategy. Value for money came up already in the debate. So if I can invite the panelists to the floor, we will be debating the value for money concept and the definition and what it means and how we deliver net return to retail investors without having too much complexity. That's basically the purpose of this debate. So if I can invite Petra, Verena, Matthias, Emanuele, and Delphine. Good that we have a gender-balanced panel this afternoon. This morning I was a bit concerned, but now it's much better. I will sit on the side. Yes. Yes. So as I said a moment ago, good afternoon and welcome back, let's say, to the session on what for me is a crucial concept. Value for money, of course, is a concept which can be explained in a moment, let's say, but from, of course, the retail investment strategy. But let me put it into a long-term perspective, has to do with also what was mentioned this morning, inducements. How do we make sure that what we pay for a certain product is in our interest, is in the interest of the consumer, is in the interest of the investor? And I often say in debates about capital markets union, look, this is a debate which is 30 years old, dates back to the Investment Services Directive, which already had a clause which said, look, we should avoid conflict for interest. This was further specified in MiFID I in 2007, which had much more detailed provisions on the subject, say that in inducements or kind of all what is forms of inducement should be forbidden or should be not be allowed, except if they are clearly in the interest of the investor. It was further detailed than in MiFID II. Of course, now, let's say we know that the Commission had to make with the retail investment strategy, that's how they then called it, a kind of a further detail on how to interpret these provisions, and that's how we came up with the retail investment strategy. 2 years ago, something like this, about 2 years ago at the end of the previous Commission, they proposed it, and of course it wasn't adopted in the previous European Parliament, it's still being discussed. We can speak about this in a moment. Anyway, I'm happy we have a very good panel to discuss this. Two heads of supervisory authority, welcome Verena and Petra, but also a market participant, then a person from a association, and Delphine also from Association Banks, the French Asset Management Association. I can ask, let's say, if you want to introduce themselves in a moment. Probably I'll start with Petra on the value for money concept. Verena to start. No, because the intention would be first, if you start with, let's say, to say, what is value for money for you? And how do you see it from your perspective? Of course, insurance sector, a sector also where this whole debate is very topical. Certainly also in Brussels, not only in the member states, but we know it is certainly a problem for insurance products. Petra.
Yeah, so thank you, Karel, and pleasure to be here. Hi, everyone. So at EIOPA, the European Insurance and Occupational Pensions Authority, we have many mandates, but we have a mandate to look at POC, Product Oversight and Governance, and that we have already for a while. And it was in that context that we looked at value for money. And what do we mean when we say value for money? When we say value for money, we say that if you look at a price of a product, then that should be a fair reflection of the costs that were made to get it there and to develop it, of the services that are delivered to the consumer, and also the returns that the consumer can get. Moreover, we do expect it to be sold to the right person, so target audience should be the correct one. So, and then we say that if you implement that through the entire value chain, so when you manufacture the product, when you distribute the product, when you sell the product, and when you provide the services that come after the sale, if you continuously keep that consumer-centric focus, where what you ask for in return is really a good reflection of cost, services and returns, then you are really serving the customer. And so it's not very difficult, actually. If you look at that, I think it makes quite a lot of sense that if you sell products, then it should go to a consumer that actually benefits from them for a price that is a fair reflection for the efforts made. And once that is properly implemented in the entire value chain, I think there's also a lot of additional checks and balances that you may even do without. And that is, I think, why value for money for us is at the core of good products for retail investors.
Can I then ask you, for example, I have, like I explained to some people over lunch, a product which I concluded when I was 33. 30 years later, how do I calculate whether I've got, as a consumer, my value for money, and what has been the cost which I've paid over that 30-year period?
Well, then we get to the next phase, which is also very important, which is cost and transparency, which comes with these services after the sale. And we feel that costs and transparency of costs is an essential part of providing good services to customers. We're not there yet, not on the pension sides, not on the IBIP side. And then you should be able to at least see it. You might not be able to understand it. And I know there's a lot of talk about financial literacy. And I think it is good to also work on financial literacy. But I think moreover, there also needs to be help through the website, through tools, but also in person to consumers to understand the product that they bought. And that comes with selling it. So the after-sales part is also important.
And then related also to the debate we had this morning, of course, and the debate on the Savings and Investment Union now is long-term investments. How do we promote to take an engagement long-term, investment-wise, for a consumer? Because also that was part of the discussion this morning. We should be able to have flexible, products, transparent products. If we say, look, we don't get a return or the costs are far too high, we change. But we often see it is difficult to change or impossible to change because there is a tax benefit or etc. Or they make it impossible to get out of a product except if you pay high fees.
Yeah, so I think from an EIOPA perspective, why are we interested in the Savings and Investment Union? We come from the angle of the pension gap that we have in Europe. With 1 in 5 Europeans at risk of living in poverty, something has to happen. So from that perspective, we would really welcome people saving more for long-term, for retirement. Now, in the dialogue on SIU, we need to make, I think, a difference between a long-term savings product, but still liquid, and a product that is there for retirement. So that not only has a pay-in phase, but also a pay-out phase. And I think here, in both cases, it's essential that at the end of that trail, the person gets value for its money. So I think the first part is that we lean more towards a retirement product that actually delivers also a good retirement, so a good outcome. On the ability to be able to switch products, but I think also Verena can say something about this. I think you always need to sell the right product. You also, if you start to realize, if you sell a product to someone for 20 years, then or you have a client that wants a product that has to pay out in 20 years, that's what I said about the target market, then that should happen. Do we see that? Not always. We see products which clearly only have a result for consumers after 20 years being sold to target markets that lapse after 7 years. Now that, in the context of value for money, is an issue where a conduct supervisor has to intervene. So maybe the product is a good product, but not for that particular target market.
But also, if you see as a supervisor or a representative of supervisors that the return has been far too low, or that has been badly managed, do you intervene?
We do. So, and I can be very open here, that's called POC supervision, so product oversight and governance, that did not have the first focus. We started with Solvency II. What I've seen in the last 3 years is that with Solvency II in place, there will be some changes, but the practice is there. The shift is focusing to conduct supervision, And here is where EIOPA supports the national supervisors by doing benchmarks. And what are benchmarks? Benchmarks are assessments of products with identical features being sold in the EU market. And then we identify why that they have different returns, that they have really different costs. And we ask the question, why is that? And that's where the dialogue of the national supervisor then starts. Now, it could be, Karel, that the supervisor says, oh, that doesn't surprise me, because in my market you have these specificities, so this is not worrying. But it could also be that the supervisor says, this is actually really worrying, I'll start the talk. There are some cases where even EIOPA involvement has been needed, and I can say that these were cases that popped up more through looking at this, so through the conduct angle, than that where it started, than through the prudential angle. So by now I really see that problems in the conduct side, with the quality of a product, with the returns of a product, with unexplainable cost of a product, are a very strong signal of issues that in the absence of capital might actually result in more problems in that entity. So it's something that not only is good to act on, but we have to act on that. And finally, if we find it, we will ask for a remediation plan. We will ask that if we have found bad products, they're taken out of the market, but it doesn't stop there. We ask the entity to also go back to the consumers they sold it to and help them. The most difficult part there is activate the consumers and find the consumers who already sold the product. So it's not straightforward, but we are quite relentless in making sure the insurer doesn't give up. Or the intermediary.
Of course, these things are quite time-consuming if you have to do this, sometimes for limited results. So difficult for supervisors to do, because there was a lady this morning who said, look, in Austria, there's been the example of the pension funds, let's say, which had an underperformance of 20%. Of course, if you want to promote a saving and investment union in this context, forget it. You have lost 20%. I turn to Verena, a bit from the same perspective. How do you look at value for money from your perspective?
So good afternoon, first of all, and thank you very much. It's great to be here on this panel, and thank you to Better Finance for organizing the conference. And I can very easily follow on from what Petra said, because I think the fundamental concept behind value for money, for me, is very much about fulfilling the legitimate interests of the investor and his or her needs. And in the end, that a product actually offers a good risk-return profile at a fair cost. And I think it's important because in the context of particularly the retail investment strategy, we very quickly always focus on value for money benchmarks. But I think it's important to say that that is just one aspect when it comes to thinking about how can we ensure that in the end the consumer gets value for money. There are other aspects, as Petra rightly said, through the whole of the investor journey, where the supervisors, the regulators need to take steps, whether that is on the product governance, whether that is in the sales process, whether that is in the alignment of the interests between the firm and the client. So benchmarks is just one aspect of this, but clearly it can help, again, as Petra said, to try to highlight where there are potential problems.
Same question then as I asked to Petra a moment ago. If you look at performance in funds, Petra is more looking at the insurance product of guaranteed products. You're looking at the investment funds as part of the mandate of ESMA. And you see underperformance or, costs which are far too high. Do you act, or do you act in, or do you look at different markets? Do you act in cooperation with national supervisors? Are there measures by which you intervene?
So there is quite a lot of activity, actually, both at the European level and at the national level. And I would very much see it as a joint effort, because in reality, it is both about at European level showing what the actual cost and performance outcomes are. And we try to do that through our annual cost and performance report to really show where there are still pockets, even though overall costs are declining a bit. The fact is there are still huge differences between member states. There are still huge differences between different types of products. And so what we are trying to do with our kind of analytical work is trying to show with a lens where there are potential issues. And then, very importantly, we do a lot of work with the national, excuse me, national competent authorities, where we actually go into working with them and them working with the supervised entities to look at specific parts of that investor journey, and how can we ensure that through that the value for money in the end comes through. And so that is, for example, doing common supervisory actions on the suitability, on the product governance, on the question of costs, undue costs in funds in particular, and a number of other areas. So there is a whole host of different initiatives we've taken over the last few years, really working with the national competent authorities to jointly try to pinpoint where are there shortfalls at the moment, where we believe the outcome is not the right one, and how can we deal with that. And I would just want to give one example, which is the Contacts for Difference, where we obviously went even one step further a few years ago, and where we said this product on all evidence does not, or is in the vast majority of cases not delivering good outcomes and value for money for the investor. So we actually took some quite drastic action in product intervention and so on.
So we, yes,
and because you said that this is not good for consumers, if there are, even if it's not the majority of products, but you know, up till 20% we see still needs some improvement. It's also not good for the industry itself. And I think the big example, my home market, the Netherlands, there was across the board mis-selling. People bought a mortgage, and then while they were buying it, they got something on it for insurance, and it really would not do what they thought it would. It would help them save to pay off the mortgage. It didn't, and that now has resulted not only in a ban, but on commissions, but moreover, people don't buy that product anymore. And this is now, this is from 2005, this is 20 years ago. People do not trust the product. The reputational damage, if you as an industry don't work on, and I'm fine with doing it behind the scenes, products are leaving the shelves now that we focus more on it. So we need to strike the right balance. We also need to see that there's a lot of good out there in which you can invest, and it will give you a return, and a better return in your bank account. And I think both are true and important.
So important, let's say, task for supervisor. But then I have a follow-up question, because I discussed with Verena in a previous panel, I think 2 weeks ago, I mean, that there is insufficient budget for supervisory conversions, for peer reviews. But I saw in the Savings and Investment Union communication from last week that the Commission wants to give more attention to this. So you expect more budget for this?
That would be very nice. I think what I certainly welcome, first of all, the Savings and Investment Union strategy, obviously, from the Commission. But in this particular area, what I think is really welcome is that they emphasize the importance to focus not just on making the regulatory regime better to serve citizens and companies, but also to think proactively about the supervision. So it's not an afterthought, it's actually core to the strategy of improving how we supervise collectively in Europe. And part of that is obviously, and will remain in the vast majority of cases, the convergence activity between different national authorities, because they will remain in charge of supervising the vast majority of the firms and products. So as a result, I think thinking about what more powers do the European supervisory authorities need to really make the convergence towards common good supervisory outcomes happen on the ground is really important. And for that, budget will also be an important point, because in the end, convergence activity is not easy. It requires a lot of common efforts, and it requires a lot of resources, because you need to bring the national supervisors together, you need to analyze the data, you need to take action collectively, and that is something that is not done easily.
Petra, you want to comment on that, on the supervisory convergence from your perspective?
Yeah, so maybe, and I agree on everything Verena said on the cost side, but there's another side to it. Let's go to the peer reviews. So you go in, you do a peer review, and you have findings, and then you agree. And that's always as a board. So that's with the 27. You send the recommendations. Now, what if it's really strong recommendations? You can even go, if it's really strong, you do breach of union law, you send a recommendation. The point is that the implementation of the action that needs to follow is still with the national competent authority. If the national competent authority, for whatever reason, is unable or unwilling to implement, then there is no follow-up of the required action. And here, the powers of at least of EIOPA, stops. So, and the detriment continues. And this is, I think, and this is what I keep saying. I don't think we are ready for, yet today, this year, for the European single supervisor discussion. But we do need to discuss this one particular problem, because you can have one license in the EU and sell in 27 countries. But if there is detriment, you have to act. If that supervisor doesn't act, then the other supervisors collectively in EIOPA need to be able to stop the detriment from happening. And that's currently not possible.
That surprises me that there is no, say, that's difficult to act even through the ESAs.
Yeah, the issue is that in the end, our whole system is based on the principle of subsidiarity. And the reality is the end supervisor in charge at this point in time, except for a few cases where ESMA actually is the central supervisor. And obviously, we would argue there should be a few more adding to that. The reality is, in the vast majority of cases, it is the national supervisor, and we can make recommendations and so on. But in the end, the final decision remains at national level.
But the Commission could act eventually. If you say the Commission, this is flagrant, whatever violation.
It's a breach of the law. So, but a lot of the time, the individual supervisory judgments around, is this product, is this governance process meeting the legal requirements or not, and it's not about the firm. The Commission can only act as to whether the supervisor has actually properly implemented and is using the law. It's quite a difficult case when it comes to these type of discussions.
And it takes forever. And in that process, detriments to consumers continue. So we sit with 28 at a table in Frankfurt, and we know that every month a couple of 100 people buy a product, and they will never see their money again. And we can't stop it. And that is not good.
Indeed, not good certainly for Savings and Investment Union if we want to promote long-term products. We go to Emanuele. Emanuele, you present an association which is active amongst advisors in long-term savings. So can you have your perspective, but probably say something about your association first? No, it's not.
No, yeah. EFPA is, I would say, the leading professional standard setting body for financial advisor and planners in Europe, since we have started 25 years ago in designing different certificates to evaluate the knowledge and competences of the people working in the financial sector. So our aim is to try to get a higher competencies in the field of the financial advisory activity, bringing some competencies and knowledge to financial advisor and financial planner. When we started in 2000, we designed just two main certificates, the EFP, the top one, European Financial Planner, which is a 40 days equivalent classroom program with two final exams, and is mainly designed to people having to do not just only with private clients, but also with company owner, with a lot of different needs, and not only investments, but also retirement, estate planning, and whatever else is linked with top clients. Then we got a second level certificate, the EFA, European Financial Advisor, 20 days equivalent classroom program plus final exam, mainly designed to people working with private clients on investments mainly, but also on insurance and pensions. When the ESMA guidelines came out in 2015 on knowledge and competencies, we decided to add two more levels of certification, exactly designed on Article 17 for people just offering information on single products, and Article 18 for people offering a basic advisory services. And so we added two more certificates. In 20, we also launched the two more additional certificates completely devoted to ESG matters, kind of add-on certification, just EFPA ESG advisor, and later on, last year, EFPA ESG expert advisor. What the results? At the end of 2024, we reached 90,600 certificate holders, which is a huge result. That's why.
So you issued the certificate, your association?
Our association accredit training center which are separate by us, because we don't want to have the conflict of interest of being at the same time the trainer and the examinator. So we organize ourselves in different countries because we like to offer the certification process in local language, because we understood since the beginning that it's very tough in the financial sector to pretend to have everything done in English. So we have been establishing 11 different local EFPA in the most important European country, and they agree the same program, the same structure of the syllabuses with learning outcomes. They accredit external training center to offer the training activity, and then the local EFPA organize the examination to check if the financial advisor got or not the needed knowledge to pass the exam.
But the advisors are independent, or are they linked to financial institutions?
It depends. For example, in Spain, where we have a huge number of certificates holders that are mainly coming from the big commercial banks, because they decided at the beginning of 2000s to give a strong message to the final clients, since they got previously some problem in mis-selling product. They wanted to show that they wanted to change the way of dealing the relationship with the client, getting the possibility to have higher competencies in the financial advisor working mainly for the banks. In some other country, like France, we have mainly people working as independent financial advisor using insurance wrapper. In Italy, we have mainly tied agent working for the network of the biggest banks. In some other country, like Germany and in Austria, again, people working as employee in the bank, and in Poland, Czech Republic, mainly tied agent working for the network. So it's different in the different country.
And how do you then ensure value for money, or how do you tackle conflicts of interest? So is this part of the curriculum?
Absolutely, because we focus very much on technical competencies. And when you focus on technical competencies, then it's normal that the financial advisor or financial planner, even better, when get in touch with the clients, try to let the client understand which are the most simple rules to be followed. I do just a very quick example on the most simple rule to be followed when you have to decide to invest. First of all, there is no free lunch on the market, so every return will be in any way linked to the risk. That's why, dear customer, we need to assure what is your risk tolerance or your risk appetite.
Meaning applying the MiFID rules.
Yeah. Second, it doesn't make any sense to start talking about risk if you don't take into consideration also the time horizon, because something which is very volatile in 1 year period becomes absolutely more stable in 3 years, 5 years, 7 years, and 10 years. So it should be spent a lot of time in letting the client understand how the time diversification works in favor of the client.
But that's a very difficult discipline. Optimal asset allocation, you can write books about this. So
yeah, that's true. But on the other side, I can tell you, and all in this room knows that all the analysis which have been done for institutional investor, also private client, shows clearly that from the strategic asset allocation comes out more than 9% of the final results, because the tactical asset allocation is always close to zero, and also the pickup of a single product is almost a zero game. So the strategic asset allocation is the most important one.
Okay, let me turn to Delphine, representative of industry. I mean, we had the two supervisors, the advisors, and now representative of AFG, the French Asset Management Association. Delphine.
Thanks so much. Yeah, it's working. Thank you very much for inviting me to this panel, and good afternoon, everyone. So indeed, I am Deputy CEO of the EFG, which is the French Association of Asset Management. So I'm not going to talk about every kind of financial products because I'm only representing the asset management industry. I'm talking about funds, just to be clear. So we are representing an industry which is composed of about 700 asset management companies. So it's a very diversified. We have big ones and very small ones. They all, provide a different kind of services. And it represents, now it's being official since a few days, 5 trillion of assets under management. So it's quite a very successful industry. So it's a highly competitive industry in Europe and more generally globally.
It's one of the biggest in Europe, the French asset management industry.
Sorry?
Total assets under management is one of the biggest in Europe.
Yeah, I think it's about 1/3 of continental Europe. I'm talking about asset under management,
yes,
and not a domiciliation, yes. But asset under management. Yes, it is still a very big industry with people on site working, analyzing assets. We're talking about asset managers, but we're also talking about middle and back office employees. We're talking about accountants. We're talking about analysts, ESG analysts. About auditors, supervisors, controllers, compliance officers. So it's several hundred of thousands of people working in this industry. And value for money is really, it's not a concept.
That was my question, value for money. How do you look at this?
It is not a concept. It is really their daily mission. It is to provide value for their clients. This is something that sometimes it is not very clear for everyone, but the asset management industry is a client industry. We don't have a balance sheet. We only put in place funds where there is a demand. So, for instance, if we have a high demand for biodiversity investment, or if we have a high demand for investing in water industry or energy industry, then the asset manager will look at it and put in place the team to be able to manage the fund. And we go through an agreement with the National Supervisory Authority, and then the fund is launched. So there is a real attention to value for money, because otherwise you're just out of this industry at the first step of putting together a fund. So the team, what it is, value for money. First, how are these funds selected by the industry? They are selected first based on the reputation of the asset management company, its culture, its structure, its ability to serve investors' interest over time. They also look at the skills and experience of the team which is managing the fund. For instance, they value a low level of turnover because it is guaranteeing the stability of the strategy and the performance in the long run. They also value the quality of the investment process through discipline, consistency, and responsibility of the investment strategy. They also value the net performance on a risk-adjusted basis. It means
so
that
net performance. If you speak about net performance, you have unbundling, and then you have a clear cost differentiation to see net performance on your investments.
Well, you do have. If you talk about the fund industry, there are a lot of recent regulation, over the past 10 years, which have been put in place. I will talk about PRIPS, for instance, the KIDS documentation, which actually shows a lot about, the fee structure, the cost. But I don't want to focus too much on the cost right away, because net returns is not a matter of how much the cost or the fees is. There is no relation between the net return on a fund and the fees cost. Of course, it's a part of the value, but it's not the entire value, and it's far from that. Performance is important. Diversification is important. And it's also an alignment with the interest of your client. And for me, the value for money of a fund will not be the same as for you. It really depends on what your objective is, and you rightly say that. What is your objective? Do you want to, you are 25 years old, you just make some money. What is your objective? You want to invest to acquire a real estate in 5-10 years. So how much do you need to put in a fund? How long? Which risk are you ready to take? It will be different from someone which is 45 years old maybe he's more concerned about retirement in the long term. Maybe he will take a different kind of risk. And the investment horizon is really important in that matter. So I think
is the product flexible?
Sorry?
Meaning, if my investment horizon is 20 years, can I step out of it if the performance is not good?
Well, you see, it depends on, first, it's not a recommendation, I'm not a financial advisor as well, but it's not a widely recommended to step out of funds when at some point in time you see there is an issue with the performance, because tomorrow it will be different maybe, so you have to stick to your investment strategy if you want to have some returns in the long term. You have to see, how the fund is actually performing over a long period of time, and it can change. And we're going to talk about later about some kind of funds, but definitely the investment horizon is very important. You will put less equity if you want to get your money back tomorrow, and you probably put more equities in a fund if you want your money back in 20 years, or 15 years, or 10 years. And you also have difference in equity. Maybe you may take more risk in investing in small cap, which are overperforming, over the longer period of time than large cap. But I'm not going to go into the technicalities.
Okay, thank you.
At that point.
I will turn to Matthias. We have an industry representative here as well from Trade Republic, which I think is a trading platform, correct? So
it's a European bank.
Exactly. So yeah, and a bank licensed as a bank, but mostly a kind of online broker licensed as a bank. Exactly. So how do you look at value for money from your perspective? You must be confronted with the question every day, I think.
So thank you, first of all. I am myself a business developer, and a commercial director, so with a personal deep passion for policy making. And my perspective on value for money will be slightly different and mostly brought by the experience of the past 2 years of being in direct contact myself with hundreds of thousands of young European investors taking money in their own hands. So Trade Republic is a 6-year-old. It's a European bank. We are active in 17 European countries and offering checking accounts with ECB interest rates on the checking account, and most importantly, ETF and single stocks savings plan. And we now have 8 million users across Europe with more than 100 billion euro in assets, starting from 35 billion euro early last year. So quite fast accelerating growth. And those customers are on average 32 years old. And for the vast majority of them, more than 2/3, they are first-time investors. So they are investing in capital markets for the first time with us.
And it's mostly directly in equity or in fund instruments or in?
Directly in single stocks or ETFs. So I would like to provide maybe a return of experience based on what I witnessed in the past 2 years, because hopefully having a checking account with ECB interest rate on it and savings plans for the long term in diversified low-cost assets will bring them value for money. So it started not from the offer, but it started from the demand side. It starts by what I'm witnessing, which is a radical cultural shift over the Generation Z middle class in Europe in their relationship to money. And the value for money they're searching for is the value that they will miss from the weakening of the welfare state in the next decade. So it's actually quite sad to say, but from my perspective, true, that what's driving them is actually fear. Fear of the future. And this is where I tend to have a generational disagreement with what former Commissioner McGuinness said in this event 2 years ago, when she said that Europeans are looking for downward protection, not for upside. Well, the Gen Z in the middle class across 17 countries in Europe is searching for upside. They have a deep desire to make more out of their money. It's not coming from business schools or university knowledge. It's coming from a feeling that the future, if you don't do it, if you don't change something, will not be as successful and profitable for them than the past decades were. So value for money played a key role in their decision to start investing for these millions of young European people. The other factor that is very frequently expressed by them through polls and studies we conduct and direct interactions on social media is a desire to control as well. So they are searching for value for money because they have to. And they are doing that because they want to be in control. It's a generational characteristic that they seem to want to understand what they're doing and they want to be in control of their future. From the other side, what led to that, what can be considered as a start of a success, was simplicity. The simplest possible products, single stocks, ETFs. The simplest possible user interface, removing words every time we could, removing steps every time we could, having full transparency on cost, and not transparency only through disclosure, but transparency through simplicity, having a fees grid, which is one line, €1 fee per transaction. And last but not least, which was the most difficult personally for me to go through on my previous banking career, is probably several hundreds of millions of impressions on social medias with very simple concepts like compound interest, diversification, and low fees. So considering value for money in this context, it's clearly about money. They need it for their future, and if they don't know it, they feel it. But value for money is as well about values. And simplicity and transparency are key to this new generation of European investors. What empowered us to deliver this was, and what can probably bring a lot of value for money to European investors, is clearly competition. Competition through innovation on processes to reduce costs, and what is preventing us from going faster, and what the value for money cannot become, as well as a retail investment strategy, is fragmentation. We are already facing, I am personally facing on a day-to-day basis, the largest fragmentation of them all in Europe, which is a cultural fragmentation around money topics. It is changing. There is already a culture union around money in Europe for the Gen Z. They share the same concern, same objectives. They are looking for similar solutions. So I started with fear, the fear of this Generation Z. And I will close with my fear. And my fear is that this young European investor generation, which is rising, will end up in American or Asian platforms, because we are facing too much fragmentation and making it difficult to reach scale, which is necessary for value for money.
So, which was my next question, what is your view then on regulation? That apparently the regulation doesn't work for you, meaning to create a single market. Like I think a moment ago, the commissioner said as well, we don't have a single market in finance. Is this your problem?
The problems we are facing in a very concrete way are mostly operational, the lack of operational unity across Europe, the post-trade, the tax wrappers who are not the same, the need to declare tax for customers, which is absolutely mandatory if you want to make it simple for them. That's the vast majority of our issues that we try to overcome every day is operational. It's not, it's clearly not
logistics
regulatory.
We have a time for questions also in between. If people already want to raise a point, let's say, please do. We have no insurance representative, but of course we have an insurance supervisory representative here. But we can already take questions. Otherwise, I go on. With this panel, we have heard already many different views, certainly on this key concept of value for money, which is in the retail investment strategy, and how you have different perspectives on that. But I see Verena already wants to comment.
Yeah, no, I wanted to come in because I found it a very interesting kind of horizon scanning of the different types of products and customer kind of needs actually we are looking at here. And one of the things I wanted to come back to was this factor of, yes, costs are not the only factor. It's very important that we look more broadly, and that's why we talk about value for money. But at the same time, cost can be a very important factor, because if the costs are too high, whatever the return is, whatever the diversification is, basically you are not going to get the value out of it at the end. So cost is an important factor. And then I wanted to also come back on the point of the need for simplicity. And I think this is something which, we've very much taken to heart. I think the problem is that we've tried to create more commonality in the disclosure requirements across Europe, but that has not always led to an easier process or an easier kind of set of facts to understand. So I think we need to take a step back on that and really think about how we can also use today's digital possibilities and other things to try to simplify the information in a way that actually investors can easily get what they are, where they are being offered, and that they have the right transparency.
If I can take up this question, let's say then to go to, next phase in our discussion about the benchmarks was already mentioned a moment ago, but probably ask Petra, how can we standardize benchmarks in, sorry, Delphine, you wanted to react on what?
Yeah, I would like to comment on that because, yeah, you're right, cost is important, but actually the fund costs are, very comparable now with what they are in the States, for instance, where it's we have a large dynamic for financial markets. So also this is important to track what I would say the black sheep for on certain type of activities. It is also important to value the fact that European fund fees have been in a very have a tendency to decrease over the past 15 years. And if you look at the comparable funds, for instance, because if you don't look at comparable funds, it's difficult to analyze. But if you look at mutual funds and you look at the way they're structured in Europe, then you will see that our costs are very low. So unless you compare ETF costs, which are only replicating indexes, with the small cap funds, which are, a team of people working to analyze and invest in small companies, then of course you will see differences. We have to be careful when we're making this comparison and we are putting this focus on costs, because as we said, sometimes we may put out of the market funds which are very interesting for diversification, for investing in your European economies and investing in small caps. Because the Gen Z generation, as you mentioned, if they don't have a job, they won't have money to invest in Trade Republic and other funds. So it's important also that they keep on investing in their European businesses, and it's still important to value the investment in small cap funds, which are, I agree, a little bit more expensive than the other ones.
Okay, I was going to go to Petra a moment ago. Let's say you started this discussion already a moment ago about the benchmarks and how can you set a transparent kind of for the diversity of funds, as you were saying, Delphine, the different forms of funds which are invest in different asset classes, also for insurance products. How can you set benchmarks across asset classes which are a credible reflection of cost structures which you have in asset management?
Yeah, so let me start from why did we start with benchmarks? And I think it's because I share a lot with what Matthias said about the fact that we are not a single market. And what really struck me in the retail investment strategy, and what is at the same time also my worry, because as much as we talk about it, it may not work, is that one market after the other came to explain to me that they have a very good market, that their products are perfectly priced. They have very happy consumers, and they can share data about how happy the consumers are. And so really nothing has to happen. Yet, if you look at a European level, and we've published this, the methodology, you look at the same features in a product. So it's about, is there, what kind of risks are covered? Are you going to pay up front, or are you paying on a monthly basis? Is it hybrid? What kind of risk does it take? So if you have a certain set of features, and we explain it in the methodology, and you look for products, but you don't look in one country, you look in several member states, you come across products that really have the same features. And I don't think that is strange, by the way, because I think a majority of European citizens just want something simple. And so there are many of the products with the same features. If you then look at what is on average the cost of these products, and you've covered then for the services, and you've covered for the returns, so then you are left with the costs, then I cannot explain why in some markets it's less than 1%, and in others it's 2.4%. And maybe there is an explanation. An example, in the Polish market, there's a tax on assets for insurers. They need to recover that. In the French market, they tell me it's because my consumers really like liquidity. In German markets, they really want guarantees. So there could be an additional specificity, but that not always explains sufficiently well why this difference is there. And because these costs are there, returns will be less. So I think having a benchmark as a start of a discussion is essential, but the comparison has to be between the same products in member states. Is it hard to do? I think we can. We have it now. We have made clusters. We have a lot of data on that, and I think we can get quite far with that. Now, does that mean that there cannot be clusters which actually have products that are only sold in one member state? No, there can also be clusters that have products that are so typical for that member state that we can't find them anywhere else. So a national cluster is actually very much possible within our methodology. But what we're saying is, show me it's so different. And I think that is a good discussion to have, because in the end, if I now look at insurance-based investment products, 30% is the product price. And then, depending on how you look, 30% is distribution and 40% is asset management, or the other way around. Now, why is that? So back to simple and transparent, I think the majority needs that. And I think if you have a product that fits that, I think the majority of consumers in EU is helped. If you look at the Swedish proposal, where by default people end up in one relatively simple, straightforward fund, the majority stays there. You have scale, and you're an example currently on how to do that. Final word, I like the example about the new generation, because I see exactly the same. They realize they want to invest, which I think is a positive development, because we need them to invest. It is also indeed because they realize there might be less pension through the state, and I think that is a good realization, because it's true. But then if you ask them, what do you want to invest in? It's simple and straightforward, but could be quite risky. Yeah? So it's crypto, it's Bitcoin, it's ETF, it's stock. What is the other alternative? Now, maybe we're going to talk about, might not be PEP per se, although I can today announce that the number of PEPs in Europe has increased by 100% today. we went up to 2. So we need to look at that. But what is it? What is it that, I mean, and when you're young, take some risk. I know risk, no return. So, I mean, it's good that they do that too. But what is the other product that we can offer? And as long as we keep quarreling about, I don't want it and I do this national and I like that, we're not going to get there. It's not going to happen. And they will move to other markets. It's just as simple as that.
So we could go towards simplification of products in Europe. So standardization and simplification, because we have far too many funds and consumers don't know what to choose.
Well, what if you have, let's think about PEP. PEP needs to be reviewed now, this year. what if you can come, name it different, we issued a paper where we say what you can all change on this, but what if you come at least to a label where you say, okay, if it has these features and you try to help the people to understand, if you look for an investment product, will be good because you need to start saving for your retirement. If it has this label, you can count on that it's an okay product to do. And please, let's make it one syllable that sounds sassy and then advertise it on social media so that we can line it up with the other four I just mentioned. Now, there will be, I think, a majority interested in that, or a large group. Do you then not need the rest, the niche, the people who are more advanced, who want to do it more clever, or maybe want to do it themselves? Of course you need them. There will always be those customers, and they need to be served. They are willing to pay a bit more because they also may get more return. But I think there is a group of citizens that need to start moving money out of the bank account into products with better returns, because that will help them later on. And it could also help you. But it has to be simple, straightforward, and there has to be, I think we need to help with the trust. We need to help with the trust by indicating in a way, okay, but as long as it has this, then you can trust it's an okay product. And then we have a responsibility as well.
Very important development. I mean, we at CEPS are also writing a paper on the Swedish investment account, just as an independent entity, trying to see, is it an example for Europe, yes or no? But certification or a form of kind of labeling would be a very important step in this direction. But if I can first take Verena, let's say from your perspective, investment funds, I mean, can we go to consolidation of the markets in certain ways?
So we certainly have a huge number of funds. So choice is definitely not the issue, I think, in Europe. I think the issue is more, how can we build scale? How can we keep, obviously, choice, but at the same time also try to help investors, as Petra rightly said, a bit in this huge range of different possibilities that are out there. And I think we need to be careful. You know, we've seen in the past that if you dedicate one particular product, actually that can also not work. And so we need to be careful. I think as ESMA, we've thought a bit about, what about a voluntary type label that just gives a bit more kind of guidance effectively? So I think there are various possibilities you can think about, but certainly the problem that we currently have in Europe, and I fully agree with the other speakers, is the lack of scale, the lack of a common liquid market, and fragmentation. And we need to solve some of those underlying issues to really make a step forward, to my mind.
Matthias wanted to add on the simplification of products.
So going back to the reality I've been facing. So what is bringing those young investors to start investing? It's indeed trust. But for them, trust comes from results. And they tend to compare. So this benchmark made me think, what is their benchmark to this generation? And there is one which is clearly emerging as the benchmark for this generation. It's the MSCI World Index. It's what they compare everything to. They go back to the MSCI World Index all the time, and they are using this as a benchmark. But to start investing, you need some form of knowledge and a tool. And what structural change I've been witnessing in the past 2 years is the split between the voices who bring the knowledge and the voices who bring the tools. That's a severe change for them. So it's not anymore the financial institutions that are listened to in terms of knowledge. They are listening to other sources of information, which are not yet perfect, and some of them are far from perfect, but they are very massive. So today, while we speak, there is roughly 1 million European people chatting on groups, talking about best practices for money. You have at least 1,000 creators, certified professionals from the sector, creating
Are they certified?
content.
Yes.
So, some of them yes, some of them not. And you need to give them a good certification available as well. But they are, whether we like it or not, doing it. And it's just that this financial literacy we talk about, they are doing it themselves, kind of. And it's far from perfect, but it's happening. So they take trust partly from the crowd.
So there can be bots, or it can be AI, whatever, algorithms which are providing advice as well. Huh?
And as well, good financial professionals who are willing to share their knowledge, which is as well the case. So it's a severe shift. And to remain in control of this shift, transparency, simplicity is again mandatory for this audience.
I see some questions. I will take them. One here in front, one at the back. No problem.
Yeah, just a question, most of all to the supervisors, but feel free anyone else to answer, because we were talking.
If you introduce yourself.
Matthias, Better Finance. So we talk about benchmarks. However, and you were talking, Petra, about benchmarks in groups of products, etc. However, Better Finance research shows, for example, our long-term pension returns research, that across Europe, in most markets, the real returns after cost, after inflation, is inadequate. That we talked on the first panel about how to get people investing, the magic of explaining to them the magic about compound returns. However, if the compound, if you're compounding 0, it's still 0. If you're compounding 0.5, it's not so magical or impressive. And indeed, after inflation, a lot of the time, it is even negative return.
So your question is about what is the benchmark?
Yes, if the benchmark, because if you're comparing in a market where too many products are underperforming, then the benchmark you get might also be underperforming. So how to handle that? Maybe indeed MSCI World or something like that.
Okay, shall we take 2 or 3 questions at once, madam, in the middle? So what is the benchmark? Question 1, and then there is a question at the back as well.
My second question is referring to retail investors, especially.
If you introduce yourself.
Sorry?
If you introduce yourself.
Gertrude Pils from the representative of pension savers in Austria. One of the biggest problems is the difference of tax regimes in Europe. As soon as you, for example, simple retail investor purchase a share in Germany, one in France, one in Spain, one in Italy, and maybe one in Denmark, you work approximately 2 weeks per year just to manage your tax filings, because you get the double taxation on your, especially on dividends, which are of course interesting for pension savers. Yeah, you get the double taxation and have a lot of tremendous work to get your this in order. Yeah.
Okay, so your question
my question is there something ongoing on European EU level to streamline this unbelievable or this very difficult, complex situation?
I mean, probably somebody on the panel can respond to this, but we'll take a question at the back as well. But that's indeed a problem. Let's say this double taxation, and whether you can deduct yes or no, or whether there are double taxation agreements to reduce taxes. Yes. Okay.
Yes, good afternoon. My name is Anna Martin, Head of Financial Services at BEOC, the European Consumer Organization. My question actually goes to Delphine. I mean, you heard a lot, Matthias speaking about Gen Z. And my question is, how is your industry actually approaching Gen Z and making sure that you are providing them an attractive offer? Because if I was you, I would be perhaps a bit fearing that this industry is just going online, buying ETFs, not trusting anymore your industry. And I'm wondering if there are any internal reflections, constructive proposals on meeting the consumer interest and at the same time having an attractive industry offer. And please, just as a perhaps prerequisite, perhaps not speaking about financial education, because if people are going into financial education, they are probably likely more ending up with an offer like Matthias one, and trying to educate themselves on the internet is probably not the solution for your industry. So just as a prerequisite.
Okay, thank you. Who wants to start? Probably on the benchmark question, how we define benchmarks? Yes, Petra?
Yeah, so now I don't think it's how we define benchmark. It's like if you have a benchmark in a group of products that are all actually not good because they don't offer a good return, then yes, you have an average in the end that you compare to, but you're still looking at a bad product. I think that's your point. And the thing is, benchmarks somehow became the star of the whole value for money retail investment strategy discussion. And therefore they get a lot of attention. But they really are one of the tools, at least as supervisors, that we look at. So in our cost and past performances report, and one is coming out soon, we also look at reduction in yield, which is a measure like how much do you put in, how much has come out. We also look into simply in returns and are they good or not. For costs, we look at the benchmarks. Now, and I agree with you, particularly also due to the difficult year that we had on in the stock exchanges, you saw negative returns. Now they're back into the positive, I can already say, for the future cost and past performances per report. But we see many, even though they are back to positive, they are not compensating for inflation. And so this is something that we provide supervisors with, and they need to continue the conversation. Now, depending on the duration, of course, the investment horizon of a product, you can overcome concerns in markets. But so it's a whole set that we look at. And then, Karel, if you allow me, maybe to the tax part. Yeah, I was at last week. I was in a nice round table, and at the end they asked me, if you have a magic wand, what one thing would you do to enhance pension savings? And I said, well, I would get a harmonized tax regime for that, because it is the problem. It is why cross-border pension is not working up until today. It has to do with social law, with labor law, with taxes. It is why PEP didn't work. I mean, it was introduced also in the middle of a cost of living crisis. It is the cost cap, if you still need to start it up, is not helpful. And maybe that's only a good cap if you are really already skilled. But taxes were a problem. So that is the reality. How we deal in the benchmarks for the cost with the taxes, we leave them out. Because in practice, we also see that if there is a strong tax incentive in a country to buy a product, consumers tend to look at the tax benefits, and they stop really critically looking at the cost of the product. So in a way, the benefit of the tax incentive goes to the company instead of the consumer. And also that is something we need to address, that we do through the benchmarks. But yeah, the taxation is not helping, at least cross-border. No, at least at our table, we cannot solve that.
But we have the faster directive now, which would be kind of reduced withholding taxes. But of course, it will have, 3 years, 4 years implementation.
We have maybe a 28th regime. They're still thinking about it. But I think that is then a way to overcome it.
Verena, you want to comment before I?
To quickly come in. So I think maybe just to follow up on what Petra just said, I think that's partly why I think this Swedish example of the savings investment account, I think the individual savings account, I think is such an interesting example to look at, because what they managed to do was not only look at the product offering, but they also combined it with the tax incentives and with the administrative ease of having it in a single account. And I think for me that really was the kind of thing that changed the dial in that market, which has clearly helped them a lot in building the capital market in Sweden. So, and tax is incredibly important as an incentive. We need to just be conscious of that. So the investor will be driven a lot by that in the end. At the same time, I think I also believe we need to make sure that given tax is a member state competence, and we're not going to change that overnight, I suspect. What I find really interesting is some of the efforts that are now happening with the Coalition of the Willing, this lab that the Spanish government has kicked off, you know, really thinking about, okay, if we do something like this, can we at least make sure that we think about it in the same way, that we maybe align how we treat this, and that we don't create even further barriers and fragmentation in the European Union as a result of going down this route. So I think that is a good thing. And I wanted to briefly comment back on Matthias's point of social media and the importance of social media, because I think that is one of the areas where I think the retail investment strategy is right to focus on. I think it is extremely important that we are conscious that there is a deep cultural shift going on. The idea that you go to your bank or your advisor, and that is where you get the information to actually know what you want to invest in, it just doesn't hold anymore in the younger generations. And so we need to make sure that also the information that people get from social media, from the web, is something that they can increasingly trust in. And for that, we need to make sure that we educate not only the ones that are looking at it and participating in the chats, but also the people who are working for firms or who are not working for firms and are actually doing this off their own back, often not realizing that they're actually providing advice and can get themselves into a bit of trouble.
I was going to turn to you, Emanuele, because of course of the tax issue, but also of the issue of the certification of products, not of certification of advisors. Can you label products?
Yeah, if before coming straight to your question, I would like to add a couple of comments to the benchmark and to the active management. I'm also chairman of an asset management company, but devoted to institutional clients, fortunately. I think that we don't have to invent anything new for benchmark. Once we use the right benchmark, of course, because even if on one side the young people are thinking only about the Morgan Stanley world, of course we need to use for every different asset classes the right benchmark to evaluate the different products. If we focus on mutual funds, because in case of insurance and especially pensions funds is much more complicated, but if we focus for a while on mutual funds, it's easy to classify the different thousands of products in different specific asset classes, get the comparison with the specific benchmark, and find out if there is room for active management or not. The reality, if we like or not, is that there are a lot of very efficient segment of a market where it's almost impossible to add value. Even if we evaluate the mutual funds, subtracting the part of the cost which must be given to the distribution channels, which is a lot. Because in average, once you take the cost of every mutual funds, 60-70% of the fees goes to remunerate the distribution channels. So again, when we use the benchmarking analysis, we should cut the full cost of every single product in order to keep under consideration the real value or no value.
We need to have full unbundling, yes? Sorry? Unbundling of costs, yes?
Yeah, absolutely, absolutely keen. Second, if we think about active or passive, there is no way, and so I come back to the lady who was asking, are your association doing some analysis in understanding how the ETF would sooner or later cancel a big part of the market of asset management company? That's true. In all the very efficient market, there is no room for active management. And the ETF are for sure in a very good position. And if I come back to the what is requested by the MiFID, that every single advisor should do the best analysis, the best of analysis in order to evaluate which are the funds that we should suggest to the clients. The best of analysis means exactly this: to understand clearly if we must rely on passive product where the cost is very small, rather than the active products where the active management should be so good to get the possibility to cover the implicit higher cost that the asset management imply. That's it.
There was a question for Delphine as well.
Well, I hear there is a question there, and I need to comment on that. First, your comment on the fact that the performances were inadequate. I'm not sure about the sentence exactly, but there is a study which is being published regularly by the European Observatory of Savings, and just was issued, I think it was 2 weeks ago. So I would advise everyone to look at it and actually see the performance in European funds. So you see that the performances are not inadequate. To go back to your question, of course, we are looking at the trends. Also, we are not a B2B, we are not a B2C industry, we're mostly a B2B industry. So we are, for instance, our members are distributing through Trade Republic or other kind of distribution network in bank or insurance institutions. But so we look at it carefully, and we also produce and produce ETF, and we have a leader in France in the ETF market. So the question there is more about product diversity. And something which is important also is to ensure that we keep on, this product diversity, because at the end of the day, we need capital markets in Europe to actually finance, a wide range. And I'm not sure it's the right conference to say this, but we also capital markets also have an objective to provide financing to companies. And ETF are a very good product, of course, and we have asset management companies offering this kind of product, but they are 80 to 90% invested outside Europe, so you have to know that. And if you're making a comparison, and I agree, if you compare by asset class and geographical areas, the comparison is not really fair. Because if you look at small cap funds, again, I'm sorry to speak a lot about small cap funds, but we're talking about, I think, a very interesting opportunities to invest, because there are a lot of growth and potential in SMEs in Europe. But if you look at small cap funds, there is no ETF on small cap funds. So you will actually compare them to other kind of product. I looked at it carefully. For instance, in France, you do have an index and you do have an ETF on small cap stock in France. The minimum capitalization in this index and in this ETF is 6 to 7 billion euros. This is not what I call an SME. So for to make a comparison, in a small cap fund in France, the capitalization that we use is 1 billion. So how are we going to compare this type of offering if we are not talking about the same investments? We are comparing peas to carrots, if I would say. And so this is a bit of an unfair comparison. And if you think that we can, of course, I listened to what's being said about benchmarks. I mean, the only concern that we have is oversimplification, over-standardization of products, which will lead of a, not a disparition, but maybe we are going to not increase the capital markets in Europe. So if we're talking about saving in investment unions, we should also talk about investment in Europe. And coming back to what Verena says, we are very much for a label, because we think that it is a good opportunity for European investors to get some visibility on this kind of product. So being a volunteer, based on a voluntary, approach, and in order to provide investors with visibility, I think it could work. Some products are quite complex. I mean, ETF are complex. And I don't know if you know exactly how it works, but they are complex. Their popularity is not because they are simple. They are complex. But the issue is that, I would say not the issue, but their asset is that they are eager to understand as their objective And sometimes we confuse between the complexity, the inherent complexity of the product and the objective of this product, and how easy it is to understand how the risk associated to it, the benefit of it, and the benefit on a time horizon and investment horizon. So it's very important to not confuse simplicity of the product and simplicity of access and of understanding the main principle of the main benefits of this product.
Coming back to whatever, simple products and complex products and the definitions. Matthias, you want to comment?
I just wanted to come back to what Commissioner Albuquerque said this morning. And she said that the time is now. That there is this sense of urgency that we should, probably as an industry and stakeholders, as an ecosystem, we should feel. The Gen Z, the behavior of this young generation of European investors is driven by a sense of urgency. And facing this urgency, it's to actually bring them value for money. And what brings them value for money is higher returns, lower fees, and lower tax on capital gains on long term. So the Swedish example is a great one. The French PEA, where you reduce your capital gain tax at the end, which is maximizing therefore compound interest, is another great one. And you invest only in European equities in there. So a label is difficult for me to say this in such a large crowd, but a label is just not good enough. It's just not good enough. For the stake we are facing, for the stake this whole generation of European people is facing, a label is not good enough.
And what do you want then, Matt?
We need a European version of this French PEA, of the Swedish investing account. We need something where you invest in European equities, you maximize compound interest, you minimize fees, and you minimize capital gain tax. And this is what brings value for money to people.
You need a European index then as well. Yeah, but I'm looking around because we have 10 minutes left. If there are other questions in the audience on value for money, on benchmarks, on the definition of benchmarks, but I see that Emanuele had a point as well. So,
no, just a question for Matthias. But let's see if there is some request.
Not for the moment.
Okay, so Matthias, I'm very much interested about the experience you have been presenting us, and you talked clearly that it's a young generation coming and using your platform or your solution. Are they assisted by some advisor, or they find everything, all the support in the platform? Because I'm quite worried when you say we offer very simple solution like a single stock. I'm worried because single stock, if the final investor gets just a few of them, is not replicating a market, is taking a lot of risk. So are you also assisting them in building the portfolio, or they are assumed to know what they should know?
They are autonomous.
They are autonomous.
And they are searching for coaching. They are searching for contradictory views. They are searching for facts and proofs, and they confront each other a lot. What we do as a company is that we support several hundreds of creators, people who create content around financial education. We sponsor TV programs of financial education, and we make it available on social media as much as possible. So that's how we discover this generation as well and their behavior, and we try to build an operating system where their money can go in the way they want, and they go massively by themselves for ETFs. This is what the code word of this generation is, probably ETF.
Matthias, can I add a question to that? Let's say sustainability label. Is this something your public is looking for? Is this something that is of interest? Is this something you believe you can do?
So they are investing in economical sectors that are heavily driven by the ecological transition, so renewable energies, and of course they favor, when they understand those labels, they favor ESG products. However, the accessibility of those labels is not good enough. There are too many labels. It's unclear what they stand for, and I will always say the same until it's live. What we need for that is like the Nutri-Score. We need something from green to red, from A to E, and with the ability to dive deeper if you want to. But what they need to see is something like that.
So there is a problem, Verena, for greenwashing?
Now we get into another topic.
Yes, I know, but it's related to benchmarks and labeling. And
it is, and I think indeed, I mean, this is something where we have seen a risk that, in particular, some of the funds and some of the products have, in that wave of the enthusiasm for ESG and sustainability, basically tried to use that as a marketing tool. We saw that with some of the regulations which were purely disclosure-based as an intention actually being used more for marketing and sale. But I think this is something which we do need to tackle. That is why ESMA did its fund naming guidelines on ESG names. I think it was exactly for that purpose, to try to make sure that when you see something as important as a fund name, and it also applies to the ETFs, by the way, and MSCI indices and everything else, it's being clear that, you know, what's in the package, and that actually the name reflects what is in there.
Petra, something on the greenwashing and on the green labels?
I'm very much with Verena. But maybe to add to that, we did mystery shopping, and we will come out with a report. And what we noticed that all the requirements of what you need to, all the steps you need to take, particularly also for sustainability, are not always taken. And what's also interesting is that does not always necessarily lead to a bad outcome. So I think in general, my call would be that it would be good to actually look again at every step that is required in the sales process of retail investment products. Do we really need it all? Given that maybe the correlation between following all the steps and selling the right product is not always there, and we want to simplify. I think having a more simple process could help. And I think in the past we had the thinking, if we give enough information, which is a lot by now, to the consumer, they will make a good choice. But I think maybe we need to rethink that a bit, and then we can also include the sustainability feature. I can fully see that, again, in the Gen Z, sustainable is of interest, and then it has to be really green. Maybe what I want to add to the discussion is that in the urgency that really is there, it's not just Gen Z, it's also all that have 16% now of savings of what we have in a bank account, and somehow see that we move that to retail investment. I mean, every percentage helps. It doesn't have to be everything. Why would they do that? And so there's so much talk about the products then that need to be offered and how we can invest it. But are people actually moving their money? And that is not yet happening, and we need to look at why that is. So tax incentives are key. Trust is key. So I know that the top product or savings account or label, I do think that a concrete product or savings account is much better than a label. But I also think if a first step has to be a label, then let's do that. We need to move. We need to move. That is one. Another thing, and I was happy to see it in the Savings and Investment Union proposal, is dashboards. And dashboards have so an overview per country of how much saving is there now, Pillar 1, state, occupational pensions, and then savings in retail investment. How much is there? And that is not because I want to have then a lineup of who did worst in the EU. No, I want that to be there for every policymaker in a member state to think where they want to put the public money with a tax incentives to save more. Is it going to be more, throwing more into Pillar 1? Or is it doing automatic enrollment and supporting good savings there? Or is it incentivizing a simple and good product in the third pillar? But this holistic thinking is happening too little yet in many member states. And I think it can help.
Not happening according to you, no.
Not enough, no, not enough at all. I think if there is an awareness that there's an issue with pensions, and a lot of the focus is then on the state pensions and the pillar one. That's the competency. All the way around, if I try to say something about dashboards, I'm often told that I should be careful because my mandate is not pillar 1. I can only do pillar 2 and 3. But that is the problem.
You're not Minister of Finance.
No, and I mean, I am not, but I still think that and I'm also not for social and labor, but I do think that what we have in information, what they have in information, we need to bring it together. I fully welcome the first pillar, the state pension, as a good start. It's where distribution happens. It's where we are inclusive. It's essential in a society, and we also have a lot of disparity, and that is also not good. It's difficult to reform in society with a lot of disparity. But then you also need to look at 2 and 3, and sometimes public money via tax incentive is better spent in a pillar 1 plus or in a 2 or in a 3 product than by doing even more into pillar 1. And that mindset, I think, can be better triggered if you have a good dashboard.
True, but you need to have a bit of a macroeconomic view as well and understand how finances hang together. I think we've come to the end of this panel, so that's...
Maybe I would like
very rapidly, Delphine,
to add something on the ESGs, because this is something very important, and we really appreciate the ESMA report in last July, because if we want to keep on providing funds, ESG funds, we need access to data. We need access to data. We need access to ESG
just the holistic
data.
approach, which is the dashboard.
But currently there is a concern with the discussion around the CSRD. We are really concerned about the fact that we may not have access to this data as we were expecting it would be. What we are suggesting at ESG, to be very short, is to reduce the number of, to simplify the reporting and reduce the number of indicators, maybe to 150 indicators instead of the 1,200. But we would like the scope not to be reduced. I mean, we would like the thresholds, the eligibility thresholds, not to be, modified. Because if we don't have access to data, we'll have what is important to invest in ESG and to fight against greenwashing. What is important is to have access to standardized, reliable data. And CSRD is very important for that. If we don't have this reliable, accessible, and standardized data, we'll have to buy them. And they won't be standardized, they won't be cheap, so the funds cost will reflect the cost of this data. And yes, there is a risk of greenwashing, because if we don't have standardization and we don't have auditable data available, then we have an issue. And in this report, you mentioned the indexes and benchmark indexes. The index that we use for the ETF, for instance, ESG indexes, if we don't regulate them, we will have an issue, and this is really important for them. So I would like to outline that, because it's a major concern, and we really believe we should keep on investing in SSG, of course.
Okay, as I said, we'll stop this panel here. Let's say we had a lot of issues. I would say that the definition is more difficult for benchmarks than for value for money. I think there is more or less agreement that we need to have value for money and clear net returns. But then the question is, what is the benchmark? As you were just saying, what do you refer to? What is the context? And how do you measure whether, for example, you had in the end value for money? Because what you compare it with, and would you do it sectorally, do it geographically? And that is rather difficult. I also agree with this dashboard. Let's say that certainly policymakers and also all of us need to have a dashboard. Let's say that we can refer, we have the reference point to have, but also the big problem, as we know, is, as we discussed as well, is taxation. And that is a thing which is still work in progress, which, as we know, financial integration has advanced a bit, financial regulation has advanced a lot, But taxation has advanced only very, very slowly. That's one of the areas where I think a lot of work remains to be done. We know that it was the faster directive, which was approved a bit almost this time last year, but still has a long implementation time, and there's a lot of discussion around this. So let me thank all of you. Let's say thank you, Verena, Petra, Matthias, Delphine, and Emanuele for an interesting panel. And I pass it back to Alexandra or to Jelle.